Hey everyone, welcome to the weekly review. Quite the interesting developments and bloodbath. Let's look at where we are. SPY 575-ish, Q's 500, went slightly below it. IWM 214 and DIA 417. VIX popping as well, obviously. Now, generally bearish on things, but we should be seeing a relief bounce sometime this week. The most likely candidate is from CPI. This week we have PPI before CPI. Usually it's the other way around. We have CPI on Wednesday and PPI on Thursday. This time we have PPI on Tuesday and CPI on Wednesday. And obviously the expectation is that it's going to be hot, but things are not as dire as they seem. Because aside from this print, which is expected to be hot, we because of the base effect, we're supposed to be getting a very cold print in February. We'll see when we get there, but for now, I think this will be the max panic kind of thing. And after this week is going to be up to earnings. We have earnings starting in force this week. Next week is the bigger one with some of the bigger names reporting. But let's take it one step at a time, or one on topic at a time. And the first topic is um, because PPI is first, a hot PPI print is going to give us a reaction. When CPI then comes after with a potentially another hot print, it's already priced in. So my expectation for a play out is if PPI is hot uh, tomorrow on Tuesday, then the market will sell off hard. Yields will spike, blah blah blah. Everything goes crazy. But it won't in this scenario. It won't matter what CPI is because the move has already happened. We go down and then we bounce. This could also happen because today we're going to have a sell-off. I don't think there's going to be any kind of recovery today, or it's going to be a shallow one, or something like bounce a bit, then get rejected again. Kind of what we did here with consolidation below the yearly open. I kind of think we can potentially do the same thing in this area between the Q4 open and the election gap uh, around this area. So we could consolidate below the election gap and then go lower. This is the kind of bounce I mean, not an actual real bounce. So something like this. Do stay here for a while and then do another leg down for PPI. Um, but if PPI is not as bad as feared, the the bounce can start tomorrow. And again, it won't really matter what happens on CPI. We could potentially get a double bottom. Let me delete. Sorry. Okay. So we delete this. We delete this, and just talking scenarios here. We have PPI on Tuesday. The market is already anticipating a hot print for both PPI and CPI because last week's data was very hot, and we could do something like this. Let's say we we just capitulate today, get like -2-3%, something like this, and we do something like this. We consolidate here a bit, and then PPI comes in tomorrow and it's actually decent. It's not that hot. Then we rally. We go back here probably on this horizontal level here, something like this. Go to 578, 580. Let's just say 580 for the sake of discussion because it's a nice round number. So basically for the level where we gapped down today. And we go up to this level because PPI is not that hot. Then CPI comes in. Maybe CPI is hot, doesn't really matter that much. But let's say for the sake of argument for this scenario, it's CPI comes in hot. We get another move down. We do a double bottom. Maybe we do lower high. Maybe we do equal lower low. Maybe we higher low, maybe we do equal low, something like this. But it's essentially we go up and we start a counter rally. Target would be yearly open, so 590. So this is kind of like all the negativity gets priced in today. PPI comes in pretty okayish tomorrow, not as hot as feared. Market rallies a bit, goes to 580. Maybe CPI comes in hot afterwards, or not as cool as the market would like. We do another dip down, do a double bottom-ish kind of thing, and then rally to 590. After this 590, it could go either way. Like if this would be sufficient to to make a lower high, and the next leg down, if we get a next leg down, it's going to be very, very bad. Like potentially 10% from here. Like the other extreme, we are here. Let's see where this band 2 is. Let's not go that bad. Band 1, probably here, like 550. So if we get another leg down after this short-term expected rally, which can be a long-term expected rally, like if we get good data and the market likes it, and then earnings kick in and earnings are good, then we go up. But let's assume again for this scenario that the market doesn't like it. I would assume 550 would be the minimum target in which we go. We can actually go lower than this, and yeah, not worth going into it right now. So this is kind of scenario one, meaning in whatever form the rally comes, uh, based on how this week plays out, target is the yearly open. If we then get rejected at the yearly open, it's very bad. We're probably doing another leg down and we go down much lower. So this was scenario in which we capitulate today. PPI tomorrow comes in not as bad. Then CPI comes in kind of hot. If CPI also comes in not very bad and the market likes it, we continue rallying and we still go directly here. So this is the target area for an expected rally wherever we may bottom this week, because it's very likely that we bottom this week for a short-term rally to come up. Now, the second scenario is the one in which uh, the market doesn't like PPI, and it's very similar to this. Just that capitulation will come tomorrow, not today. Like we stay basically around where we are here, the Q2 Q4 open on this AVU up from the August low. We consolidate around it, then PPI comes, consolidate like this. We don't go significantly lower today during hours. PPI comes, market goes down. Uh, I don't know. I think we break below 570, but it's difficult to estimate. So let's say 565. So we have another leg down, and I would expect that we get a V reversal. So if we get a candle, if we get a push down tomorrow due to PPI, I think it's very likely that we do a hammer candle, meaning we go down, but we close back at this level. And this again is a sign that we are due a move up. And same as before, uh, when CPI comes in, all the negativity will have already been priced in. The market has dismissed it, and same as the previous scenario, at most we will do an equal low, most likely a higher low, and then we continue going up. Target is the yearly open. So whichever scenario comes, I think we're gonna have a rally to the yearly open within the next 2 weeks. Most likely it's going to be this week. But the difference is when we bottom, whether today or tomorrow after a potentially bad PPI print. I don't know which one of this is going to play out, but I'm very confident about the yearly open target being the target when we get this rally. Now, the and why I think this is because of positioning. Like, uh, I think the biggest level we need to look at this point is QQQ, and we have this 500 level, which is the biggest one by far. Lots and lots and lots of puts, like the largest put level in all the option chain. I'll show it here as well. And we are at already below, let's do 499.99 for the sake of it to adjust the price because we gap down and we are exactly at it. If we are to lose this level and there is acceptance below this level, all hell will break loose. Like we will get acceleration down like there's no tomorrow, and could get to like 480 in the blink of an eye. Meaning, in the blink of an eye means in 1 or 2 days we could get a push down to 480 from for QQQ. But because this level is so huge and it will flip so much delta from positive to negative, I don't think we have enough uh, negative energy to push down through it. And let's look at QQQ. As you can see, we stopped right at it. There's a reason why we stopped right at it. And I don't think we have what it takes to break down below it right now. Or if we do, we go slightly below it, like let's say at most 595, and then we bounce and go back to it. So if we, it's going to act as a magnet. But it's going to act as a magnet in both directions. Like if we go down, it's going to pull us back in. If we go up, it's going to pull us back in, and so on. Same if we get a bounce today. Like if we go up, it's going to pull us back in. We don't have yet a solid enough structure to either go down from it or go up from it. So that's why we need a bit more. We need the market to decide what it wants to do. But if it decides that we go below it, we're gonna go below it quite a lot. And 480 is just the beginning. Like we can go much lower than this very quickly if the market decides that 500 is not going to hold. But for now, like at least until we see what happens with PPI and CPI, I think the market is going to decide to hold. Again, there's like a $3-4 uh, wiggle room both up and down around this level, but don't expect this level to break down first. I think what needs to happen to go down below this level is for earnings to be bad, meaning we get this sweep over with, we kind of consolidate around 500. Like the bad scenario would be something like this, something like this. Like we consolidate a bit here, it tries to go up. Well, we also have this trend line, and QQQ should underperform in this scenario because is the a drop would be decided by Qs, not by other indexes. So let's say we go buy to 510, and then when we come down from 510 after another rejection, that would be another leg down and push us significantly lower than this. But for now, it's the biggest level. Don't expect it to break down quite yet until we get a reason to do this. And the only reason that actually works for Qs is for mega cap earnings to suck. And those won't happen until I think Netflix starts earnings from the Netflix and Tesla next week. Have to look it up. Uh, Netflix. Let's do daily. So Netflix on the 21st, so that's next week. And Tesla usually comes with Netflix 29th, so a bit later. It's not next week. Tesla is the week after that. But we have banks starting and so on. But anyway, you get the idea. I don't think we lose 500 unless we actually get some bad news from mega caps. Okay, now going back to the general setup here. I think the market is kind of sleeping on the California fires. There's the issue with insurance companies or some insurance companies maybe of going bankrupt because of the liabilities they have from insurance. There's also the question of uh, California's bonds. Like aside from government bonds that the federal government issues, each individual state or individual government at a state level and at a city level, like the Los Angeles can issue bonds, San Francisco can issue bonds, and so on, municipal bonds. Um, that are potentially underwater a lot. Like I imagine yields for California bonds or for Los Angeles bonds are skyrocketing right now. It shouldn't affect government bonds at all. or only slightly. But someone is holding those bonds for California, for Los Angeles, and when you combine this potential negative impact of someone realizing those losses, and if someone who is holding those assets uh, goes bankrupt, they have to realize their losses, and this will force the other holders of those assets to realize them, because that's how it works. So there's a lot of negative potential within the next 1 to 2 months for things to go out of hand quickly. And just like on COVID, we the market carried on for another 2 months, even though everything was known since January. But the market didn't really react until February OPEX. Now we have January OPEX. We're coming in. We will then have February OPEX. So this we could have a month between the 17th here and when is the 21st in February of basically zombie mode, in which the market seems unfazed by the damages from the California fire, uh, but then suddenly it starts reacting. And maybe some insurance firm goes bankrupt, maybe a holder of those assets goes bankrupt and so on. This has the potential to start a cascading effect and give us like a 25% correction. And that's kind of my target. If things actually go wrong, my target will be a 20 to 25% correction within the next 2 months. And let's see how what's that? This is retest of the 2021 top for Qs. Actually, let's do it on SPY as well. Same kind of thing. So 22% on SPY. So this would be my target if things actually get out of hand. And it just like COVID, it will happen very quickly, meaning we have 1 month for this crash to happen. Uh, Example is not really COVID. COVID is kind of more special, but something like this. And while COVID was a situation where we went up while bad news was happening, I think due to the setup in and how things are developing here, we're looking more towards like the 2018 drop, meaning we have topped, we are going down, we are going to see this for the next month or two, and then when the market finally realizes the loss and accepts reality, we get this leg down. So let's do something like this. That was 20%, by the way, on SPY. And we have topped. I like this better because we're making lower highs already, and I don't expect the market to go back to the highs no matter what happens. So something like this. And we are in the process of a new leg down. Let's say we consolidate here for a while, and then we do this kind of move down, which should come in theory between February and March, if it follows uh, the same structure as the COVID crash, and something like this, probably potentially lower. Consolidate here for a while, and then we do another leg down. It doesn't have to be 20%, but I would expect it to be more towards the upper end of not towards the more towards 20 than more towards 10. So this is kind of the risk I see in the markets right now. I don't think we see new highs for a while, even if earnings are good. I think earnings being good are the minimum requirement for the market not to break down. Expectations are so high that it's hard to satiate the market's desire for good outcomes. So I think earnings will only save us from breaking down, but I don't think we can break out to new heights or anything like that. We need a longer period of consolidation here. At most, we can go back to 600, let's say, if earnings are very good. But other than that, I think there's a potential for disappointment, quite a lot of potential for disappointment here in the current setup in the market. So there's going to be a lot of opportunities for swing trading and buying the dip for short-term moves in the or getting put for short-term dumps in the next 2 to 3 months, I think. So this is kind of how I see the situation right now. So short-term, expect a bounce this week because we are at negative optimism, max out negative at max pessimism. Like I can't talk anymore. But the potential for further out moves is still quite negative. So I think the market needs to prove that it can like bulls needs to step in and push this higher with conviction and belief and take back key levels like the yearly open. But for now, I don't think it's possible to take back the yearly open. I think it will act as a resistance when we go into it, but it's very likely that quite by the end of this week, we will be retesting this yearly open level, even though we may push just under 570 briefly due to a hot PPI CPI combination. But baseline is something like this, either by pushing below 570 as low as 565, something like this. It could also be here. So kind of this is the baseline for everything. Yeah, that's it for this week. Have a good one. Bye bye.